Good morning, Jeremy, and thank you very much to yourself, Isaac, and Craig, my fellow panelists today, and also the UK Investor Group. Really appreciate the opportunity to talk about our investment trust. So I'm going to go to the next slide and leave it there for a second. And just before I jump into my presentation, I just want to take maybe a macro observation that I think is very important for the area that EJF focuses on, which is financials, US-based financials. That's our focus. And in particular, focusing on smaller cap financials, both banks primarily, as well as insurance companies. We had the visit, you can tell by my accent, I'm an American. My company is primarily based in America. We're based in Washington, DC, and we have an office in London where I'm sitting here presently. We had a state visit by President Trump, and I think he, in very Trumpian fashion, said it was the first time there's been 2 state visits by a president. So of course that's Donald Trump vintage. But the point I want to make is really focusing on the conduct and the actions of King Charles and also Prime Minister Keir Starmer. I think both of them understood that if you lined up their policies and their priorities with those of President Trump and his administration, there's probably a lot of differences. But they understood that they had to be very jugular and prudent, and they had to focus on what would be the best thing, for the UK, long-term, short-term, medium-term. And I think they did that quite successfully. I think they were able to convey and take advantage of the fact that President Trump does have an affinity for the UK, and he is interested in getting the relationship strong between the two countries. So why do I bring that up? Because where we focus has been in an area that's been in a tough period in right after the great financial crisis. You had low interest rates, not very much for a bank. In financials, you want to borrow short, invest long, and that's very hard in a very low interest rate environment. And then we've had the Biden administration, and before that the Obama administration, which were very against, in general, M&A. And so from an investor standpoint, if you step back and you now look at financials, it is I've been in business for 25 years in investing and been around the financials sector. And it is the best time that I have seen to invest in financials, both in equities, which this trust does not address, but also the debt. And I'll get into exactly why. And the trust here focuses on the debt issued by small banks in the United States and small insurance companies. And because of the regulatory change that, whether you like them or hate them, it doesn't really matter. There's regulatory change that's really conducive to our strategy at this point in time. Secondly, and I'll get to it in a moment, is interest rates. We're starting, and it may be slow, but we're starting into a lower interest rate environment on the short end. But you have inflationary and other factors, growth. I think Trump is stimulative as an administration. For the second term, he will be, just like he was in the first. And I think that will create a higher yield curve, which is what banks and insurance companies ultimately do, which is borrow short, lend long at a higher rate. So that net interest margin, that expansion is going to happen and continue to happen. So we think that's incredibly smart. And then because of the regulatory changes, we're going to see, and we are already seeing in the 8-9 months that Trump's been in office, a ratcheting up of M&A, mergers and acquisitions, among small banks in the United States. So I bring up the state visit just to say, if you look very prudently and you look very focused on where can I make money now without putting emotions involved in the equation, I think you'll find that our strategy is a very attractive strategy, especially for those investors who are focused on a kind of sleep at night kind of yield. That's what this trust is. It's not sexy. It's not going to produce equity volatility. It is going to produce a very steady Eddie credit performance on small banks, and it's going to have the tailwind of that M&A, which I'll get to in a moment. So first, let me talk a little bit about EJF Capital. Then I'll talk about the trust and our metrics. We've been listed since 2017, April. So we've been around 8 years, and we've performed well over that period. But the trust, even though it's quite small, it's a little over £100 million pounds. It is part of our global footprint, which is $5.5 billion that we manage. We've been around 20 years. We just celebrated a few weeks ago EJF Capital's 20th anniversary, and we are basically an institutional shop. Our investors are very pension. We have about 25% pension, 3 sovereign wealth funds, and a host of other investors, but it's really an institutional shop. Going to the next page. In terms of the trust, we've had an 8.3% annualized NAV return, and I'm very proud of that because we've had in that 2017 to today, we had the COVID period, which really hit financials. You may recall back in 2020 March and its aftermath, equities and financials went down like 40%. And also 2013, we had a sentiment-driven 3 bank failures that was not something we were exposed to because they're kind of the super regional banks that we do not. That's not our area of interest. We're focused on the small SME basic lenders. Those are the folks that we focus on. In America, there are 4,300 banks, and most of them are in the category that we look at, and we focus on basically about 1,200 of those 4,300 banks. We do not participate in the GSIB, JP Morgans, Wells Fargo's of the world. That's too efficient a market. That's not where we focus on the equity side or the debt side. And the same with the super regionals, which have their own idiosyncratic risks that Silicon Valley, First Republic, and Signature Bank all displayed in 2023. In terms of where the stock is trading, right now it's about a 20% discount. It's a great entry point. It was as wide as 42%. I'll get into in a little bit the strategies that we've done to narrow that discount. We've done that successfully from about 42% to 20% where it is today, and we do think it'll close even more in the near term. In terms of our shareholders in the trust, now focusing on the trust, I just direct your attention that we have Premier Miton is our largest single. These are various funds managed by Premier Miton. The bottom of this list, you also see that we have Newton, which is owned by Bank of New York, Mellon. There's a UK insurance company in the middle there. These are all the publicly disclosed. We also are proud to have Jupiter as one of our managers or one of our investors. In terms of what EJF owns, we own 26% of the company's ordinary shares. We're very aligned with the investor here. We just announced, or I should say the board just announced on the investment trust, that we're doing a tender, which is the first time the trust will have ever done that. It's a 5% tender at a 5% discount to NAV. That's going to be done here in the next month or so. I think it closes sometime in October. But we are not tendering any of our shares. EJF Capital, I'm personally invested a considerable amount, which is public information, but also the EJF Capital. We're very invested. And why? Because we really like this investment for our balance sheet. It's just a steady Eddie, sleep at night kind of yield. In terms of what we own, 72% of our assets are in a debt issued by banks that are regulated and insurance companies which are regulated. And so the debt that's issued must be approved by regulators. This is not high yield. This is not general corporate debt. This is regulated corporate debt. It's investment grade if you look at it from a pooled basis, and it must be paid. It's not the European bank debt which has bail-in features. This debt is a must-pay security. If you don't pay it, then you are subject to potential seizure by the FDIC. So this is very, very different than other kinds of debt and very different than the bank debt that's issued by European banks and UK banks. And then we also have 5% of one of our asset management streams is owned by the trust, and that provides that steady Eddie dividend that we've been paying. And I will note that we've had a dividend is paid every quarter since we listed. We've never decreased it. We've never suspended it. We have increased it, I believe, twice over our 8-year period. In terms of why would you invest in small banks, this goes back to some of the factors I mentioned earlier. There's a lot of numbers and figures on this, but I think the important thing is to say EJF's primary investment focus you'll see is in the small. These are banks that are zero, not really zero, but up to 50 billion in assets. and sometimes we'll go to the up to 100 billion in asset banks, the regional banks. And why do we like this area? It's very simple. These are very transparent balance sheets. They're not complicated. They're simple to understand. They disclose their data regularly. And in the bottom ribbon there, the M&A activity is incredibly important. Why is that important? If you own debt of a bank A, that is 10 billion in assets and it's trading at a certain yield, let's say 8% their sub debt, and it is purchased by a bank that's 80 billion, so 8 times larger in asset base, and their debt's trading at 7% yield. When those two banks combine, the debt of the smaller bank will trade from 8% to 7% in my example. So you do get not only steady eddy income and yield, you can get a pull up in the value of the debt securities you own because of the M&A. And so that's very important to understand in the strategy. In terms of kind of a why now, I mentioned this a little bit earlier, but the regulatory change is really material, very material. And again, you don't have to love Trump, you don't have to hate Trump, it really doesn't matter. He has put people in positions that are deregulatory in the sense of M&A in particular. And I think that's the important thing. It's that he and his administration, and I have a quote here from Travis Hill, who is the incoming FDIC chair, and he's basically saying if you come to the regulator and you meet all the requirements of the Bank Merger Act, then we will approve it. So they're they kind of want there to be less banks, and I think that's something that actually makes a lot of regulatory sense. Are we going to get to a point where we're like the UK with 200 banks overnight? No. Are you going to get to 1,000 banks over the next 5 to 10 years? That is possible, and I think that's the tailwind we want to take advantage of. Also, in the One Big Beautiful Bill, as it's so named, it did lower the corporate tax rate or extended the lower tax rate at 21%. That's incredibly important. Michelle Bowman being appointed vice chair for supervision. She is a small bank community banker. That's what she's done in her career. She understands the particular challenges of small banks, whether it be technology spend, whether it be meeting qualitative regulatory requirements as opposed to quantitative versus qualitative. She focuses on the quantitative issues, not the qualitative issues, which were a little bit more accentuated during the Biden administration. The last point is what I was speaking about earlier. We do foresee, and we're already seeing, a steepening yield curve. And that is, if you're a bank, that's literally how you make money. And so the environment is dramatically improved than what it's been, since 2020 post COVID. In terms of the underlying bottom line bank debt that we own, this is 10-year paper, but it really had, the key is that structure. It's a 5-year no call. So that means for 5 years, it's a fixed rate. In today's market, it's really more like 7.5 to 9.5. The slide says 8 to 10. It's really 7.5 to 9.5 in today's market. 5-year fixed. So think about that kind of paper in an environment where interest rates will be coming down. That's really, really attractive. And why do banks issue it at this level? They don't do it because it's the cheapest cost of capital. That would be deposits, right? They pay, you're probably, everyone listening here has a deposit at a bank and you're getting almost no interest. That's the cheapest cost of capital for a bank. They issue this paper because they need to. It's to meet regulatory capital requirements. And so they're issuing it for a non-economic reason. And that's the best kind of investment opportunity, a non-economically driven one. So in this environment, we can make unleveraged 7.5 to 9.5%. And then through modest leverage, we can get our yields much higher. In terms of, I've talked a little bit about what's happening in M&A, so I won't belabor that point. But I think the important part is the debt that we're buying. Again, this is about 72% currently of the portfolio. Probably will go up to 80. And this is subordinated debt, that 10-year piece of paper, 5-year fixed, then it goes 5-year floating. But banks pay it off typically after 5 years because they lose regulatory treatment on the next 5. So it's about a 5-year duration paper, generally speaking. There is going to be a refinancing wave, and we're already seeing that happening over the last 3-4 months because banks issued paper, guess what, 5 years ago. 2020, they issued a lot. Why? Because interest rates were low. Now they're much higher, so they have to refinance at a higher rate. So it's very interesting. 2021, That's next year, 2026. And you can see through 2027, over the next 2 years, there's going to be a refinancing wave. So we're very excited about the amount that's going to be out there. And then we can selectively buy it for the trust. M&A activity, I'm not going to spend a long time on this slide, but it's basically giving you the facts and figures of the various administrations. We are seeing the number of deals this year are almost exceeding all of last year, 2024, and we're only in September. And almost as importantly, you're seeing that the time for approvals is diminished. It's almost half of that 151 days under the Biden administration. So we think that's incredibly important. And then you're also seeing the administration allowing like a Capital One to be merged, with banks that are of equal size, Discover Bank. So that would be unheard of in the last administration. So we're seeing incredible M&A, and I think again that's super important. So on banks, again, a lot of people look at banks and they go, oh my gosh. Look what happened during the Great Financial Crisis. Look what happened in 2023. In 2023, there were 3 banks that were seized out of 4,600 banks. They were prominent banks by reputation, like Silicon Valley in particular, but there weren't that many. And you can see by this chart that banks are, and since the Great Financial, the underwriting standards have been imposed on them by the government. I don't see that changing under Trump. I do see M&A accelerating, as I've mentioned, but I don't see underwriting standards. And the second thing with banks is that they're very, very they really need a shock to the system. And with what's happening in private credit, I would submit to you all the kind of the riskier lending activities in America are being pushed to the growth of private credit. They're taking on that risk, whether it be the Blackstones, the Ares, the KKRs of the world. That's why those funds have really increased, is because the underwriting standards of small banks have gone down quite a bit. And I would mention that we've had one default since the listing of this trust. Of 166 different banks that we've invested in the debt in this trust, we've had one default over that 8-year period. This is sleep at night kind of debt. We often get the question about the real estate exposure as a concern. You can see that this chart basically shows that you've had almost very, very little CRE problematic. It's less than 50 basis points. Where you're seeing problems in real estate are really the urban, large multifamily projects that are $100 million loans and up. Those are not made by small banks. Those are made by the super regional and the large GSIB banks. This is probably the best chart. You can see this is bifurcated. This is basically default or net charge-offs by size of the bank. And you can see the green are the commercial banks over 100 billion in assets. That's the green mark. Everything else is at historic kind of lows. And then the shadow banking, that was the point I was making earlier, that a lot of the growth of private equity and private credit has been taking on the risk part of bank lending. Banks have been slowly turned into effectively a version of a utility that's highly regulated and lending kind of basic lending, asset-backed to their local communities. Last couple slides, then I think we'll go to questions. In terms of our risk-reward characteristics, I think it's very important to understand I'll just point your attention to the risk profile, which is the fourth heading. Investment grade is what 72% of the portfolio. It's BBB, BBB minus. We have obviously cash and cash equivalents in the trust, and then we have small bank CRTs, which it's hard to put a risk weighting on those, but they typically are prime level and asset-backed loans. So that's right now about 8% of the portfolio. We do expect that to go above 10%. So in terms of what are the risks of investing in the trust, what are the things you should be concerned about? Liquidity is certainly one. It is a small trust. We have increased, as you can see, 3 to 4 times the volume over the last 12 months. How have we done that? We've done more outreach like these kind of forums where we're talking to investors, getting more retail interested in the trust instead of just our institutions that I pointed out are the largest holders. We think that's very important. We've also we have been taking EJF Capital 20%, and this year, next 12 months, we've committed to buying 10%, taking 10% of our management fee and buying more shares. That has really helped squeeze that discount. And then the board in December through an AGM, or EGM, we got approval from the shareholders to do a 5% tender for each of the next 5 years of the shares, and that we do think will have an impact. So there's really been an effort to try to narrow that discount. So I think the entry point right now is quite interesting for investors. In terms of our board, I would just mention that John Kingston joined us a little over a year ago. He was the vice chairman of Affiliated Managers Group, which manages $700 billion, public U.S.-based asset manager. And I think his kind of constructive experience in the asset management business is really a good catalyst for additional steps to move the trust forward so we can grow it. That's really our desire. So I'll stop there and maybe field some questions from Jeremy and maybe the audience.
Yeah, look, thanks so much indeed, Neil. Very interesting. As I said, a bit of a change of gear, and it's very interesting to get an insight into the small bank market. Just a few questions come through. What's your average dividend growth rate since inception? I noticed on page 16 you quoted 7.19 year-to-date total return, excluding FX effects. Of course, you report in sterling, so those investing here don't have an FX issue. What's the historical dividend payout been like?
The dividend, we've raised it twice. I think it started out around 6%. We're at like 6.5, I think now, 6 3/8. So it's really buying it on the shares that you get that higher dividend. But I would say that what we've been investing in the last year. So in March, we did an investment in a pool of small bank debt that was yielding 16%. And that was a refinancing of a 2017 investment, which was at 10%. So again, 10 to 16. We just closed a deal in last week that's yielding 18%. Again, a pool of small bank debt that we then apply some leverage to. That was refinancing a 2019 deal that was at 11%. So the dividend yields are going up. Our CRT investments are all mid-teens. So I can't, of course, say exactly what we're going to do on dividends. That's really the board's call. But the forward looking is higher yields based upon what we're investing in today versus what like I indicated at the outset, from 2020 to 2024, it's been a low interest rate environment. And that has now changed with things ramping up, starting with the end of 2022.
Yeah. Quick look at the macroeconomy. Are you concerned about the recent drop in US job creation? I think the question there is, if there is a US slowdown, to what degree is there a risk to income from the fund?
No, that's a fair point. I think there's a very little risk with a recession, even a somewhat deep recession, which we are not anticipating. We're not even saying there will be a recession. But that's the history. I'm basing that on being in this space for 25 years. The risk to this strategy, other than kind of the size of the trust and the discount, those kind of things, the risk to the underlying assets is you can't have a heart attack to the system. You can't have the great financial crisis. And what has happened since then is a regulatory response, which was very appropriate, which is to increase those underwriting standards and to raise capital levels. So banks today, the small bank cohort that we're invested in, has 50% higher capital levels than they did at the time of the great financial crisis. And underwriting standards have gone tremendously higher. Best evidence, as I mentioned earlier, is the growth of private credit funds. So I think that's a recession doesn't worry us. We're not anticipating it today. Obviously, there will be one down the road, and that's not a concern historically for the debt of small banks.
So to another question, what are the key attributes you look for when picking out banks in which to invest? Because clearly it's all about quality. You talk a little bit about some of the issues, debt and rates particularly. How do you go about the process of picking which bank to look at?
No, that's a great question. So we try to have geographic diversity. That's one. But we're looking at the bank management teams, and then we're looking at the kind of loans that they make. So there's certain areas that we avoid. For example, Banks that lend a lot into the energy space, which is incredibly volatile, we screen those out. So we have less, for example, Texas, Louisiana banks than you might anticipate if you just said, you just kind of do it by how many banks are in a state. We also look at, office is not a big exposure to banks, but to the extent there is office exposure, we want it to be owner occupied. We want it to be the dentist office who owns his building. We want it to be the medical practice. We want it to be the dry cleaner who owns his space. So where there's personal guarantees behind that. So we want asset-backed lending, and we want simple SME community lending. That's how we focus. And we don't go to the smallest banks, but we do like those banks in the 3 billion to about 50 billion. That's our cohort. And we want them to be run by good management teams. It's best if they've lived through the great financial crisis. They've had that experience. That's very, very important as a screen. And we've been doing this a long, long time. My company, this is what we do. We're a niche investor. We're known as the small bank guys in America. And there's a good reason. Why do institutions invest with us? Because this is an area that we know and we've been cultivating for a long, long time.
That's really key, isn't it? A company that's had the exposure to the great financial crisis has that inner strength and core and knows how to deal with a downturn. One other question, what does the concentration of the portfolio look like? How many banks do you have exposure to at the moment? You talk about quality, you talk about certain sectoral choices you're going for, geographical spread and so forth, but in terms of quantity, are you at peak numbers? What are your numbers at the moment looking like, or are you looking to add to your portfolio?
We're close to peak numbers, but roughly we have about 360 different, if you look through the portfolio, we have 360 different debt securities representing, and it's about 80% small banks, 20% insurance companies. And then in terms of what was my thought there? In terms of the number of different banks, it's about 160 banks right now. So they're multiple issuers, and if it's a good bank and we like it for all the reasons I articulated earlier, we'll buy their next issuance as well. Same with insurance companies. Insurance companies, we have about 60 names right now. So we're very diversified, and we're very selective in what we pick in terms of the debt. The difference with equities, which you can trade in and out of, with debt, you're going to own it for 5 and maybe 10 years. So obviously you have to be incredibly selective, and I would stand by our underwriting over the course of time, certainly.
Yeah, one final question has to be about not the global geopolitics, because I know we spoke before you went to camera about the insulation this has really in terms of the global stage, but of course it has a direct link to Donald Trump. When we talk about global politics, we talk about the effects of Trump and the potential headwinds that he might bring to international investing. But I guess when looking at a fund like this, I mean, Trump, MAGA, looking to promote the US, is the Trump era good for you?
It's great for us. And again, I want people to really, that's why I focused at the beginning. You don't have to like the man. You don't have to like all of his policies. I'm a very big critic of his tariff approach. It's just terrible. But about this phase is that we're not immune. No one's immune to tariffs. There are attacks on the system. There are attacks on free trade. However, the banks that we focus on, they have less than 1% exposure to deposits from foreigners and less than 50 basis points on loan activity. That compares to a JP Morgan, which will be like 17% deposits and 12% loan activity to foreigners. So it's not insulated, but this is domestic focused. I do think that the one big beautiful bill coming into play, the change in regulators on the ground, and that ultimately Trump is stimulative, and I think that bodes well for the banks, and so we feel, and insurance companies. And look, with interest rates, if it's kind of a perverse positive, inflation keeps those longer rates on the curve higher, and so as rates go down on the lower side, net interest margins go up, and that's great for banks.